Good morning, everybody. It's 10 o'clock. It's Tuesday. It's time for a weekly webinar. Good to see everybody. You know, I can't see you, but it's good to see everybody. Happy Tuesday. It appears to be a beautiful day. I haven't been outside yet, but after we're done here, I'm going to go out and vote. So I'll get a chance to go outside. I hope you vote as well. It's important. Doesn't matter who you're voting for, right? But just as long as you vote. So let's jump right into it. We're going to go through and we're going to do a few minutes of our Slott updates. These are updates that talk about questions that people have with IRAs. There's a lot of repeating questions out there, and I think it's always good to go through these things. It gives us an idea of what's becoming popular as far as techniques and what to look out for. We're going to talk a bit about the markets. Markets are very timely right now. And then we're going to go into a financial planning topic. Our financial planning topic this week is capital gains and losses. This is always a big topic when we have fluctuations in the market and typically, and especially losses in the market. So there are things that we've been doing for clients to harvest these losses, prepare for reallocations. So we're going to go into that quite a bit. So let's get into it. What do we have coming up? Well, we just started our Change Your World of Retirement Planning series of classes for May. So we have two series of classes. That one started on the 12th. We have one started this evening. They run for 2 nights, 3 hours each night. Yes, it's a long time. It's a long time to be in front of the computer, I think, on either time of this camera or either side of this camera, but it seems to be effective. There's a lot of material, so it's hard to get less time than that, but we're going to try that differently in June. So we have, there are 2 3-hour classes. So one started on last Thursday and we'll have another on the 19th. That's the second in the series. And then one starts tonight and we'll have another next week. If you wanted to, you can make, so you could start tonight and then finish up on Thursday. That's okay. I just don't suggest jumping in on the second one because if you want to do the whole series and do it in 3 different nights, we have a series starting in June the 9th and then June the 14th, and these will be 3 2-hour classes. So we'll see which one works better for everybody. But we run these a few times, 4 to 6 times throughout the year, so you're going to have some opportunities. So the big headline, of course, in the past week has been the consumer price index. So it dropped a tiny little bit. So down from 8.5% to 8.3%. It's still super duper high, but it is heading in the right direction, just not fast enough. But gas is up. That's a big indicator for most people, and just of where we are with pricing. And every time I fill up my darn Jeep that I love, it just costs more and more every time. So I'm thankful that I can pay that bill, but a lot of people can't. And I read some comments that there's going to be significant on the internet. There's going to be significant price increases for electricity in our area this summer. So that's a concern as well. So we're all feeling this. Hopefully it gets better very, very soon. Okay, let's jump into the Slott update. So the first, all right, let me share my screen here. I'm going to just blow up my screen a bit. And I was advised that it's good to follow along with this if you can read it. So that's what we've been doing. We're getting some good results from that. Let me move my little picture here. All right, and these are my notes you're looking at, but just for the Slott update. So qualified charitable distributions and spousal beneficiaries is what we're going to talk about in this mailbag. So the mailbag is when people write in with questions, and someone from the Ed Slott group, Ed or one of his team members, answers it. In this case, it's his fellow Andy Ives. They're all great. So I'm just not going to go on about how great they are because they're all super smart individuals and very helpful. Charitable qualified distributions have been getting a lot of discussion, rightfully so, and they're becoming a very important part of financial planning. So here's a question about a qualified charitable distribution. I think I said this deduction. It's a qualified charitable distribution. I have had my coffee this morning. I don't know what happened, but the question is, I have a 401k that I'd like to use as a portion for a QCD, qualified charitable distribution. I understand that QCDs have to be from an IRA. Can I move a portion to an IRA for the QCD? How will this affect my RMD from my 401k? Federal tax implications. Thank you. So he's asking the question about the federal tax implications. Let me make sure. I didn't ask. I'm assuming y'all can see my screen, right? Raise your hand if you can see my screen and read this question. All right. Thank you, everyone. So there, Andy writes back, you are correct that QCDs can only be done from an IRA. So you'd have to roll over money from your 401k to the IRA. We spent a lot of time talking about rollovers last week. From your 401k to an IRA to do a QCD. However, based on the first dollars out rule, the first distribution from your 401k will count toward the 401k RMD. Remember, retirement plans such as 401ks and IRAs are treated differently. They have different rules and they have different RMD rules. Since these first dollars out are considered RMD dollars, they cannot be rolled over. So RMD dollars cannot be rolled over and they cannot be converted to Roth. Only after the plan RMD, required minimum distribution, has been satisfied could you then roll additional 401k dollars to an IRA for a subsequent QCD. You know, a lot of numbers and terms, right? The plan RMD will be included in your income while the QCD is not. So what Andy's telling this person is you can do a rollover from your 401k, but first, if you're over age 72 and you've already crossed that required beginning date, that's April 1st of the year following the year you turn 72, you must take an RMD. And the plan custodian, Fidelity, for an example, right? Whomever it is, their first, if you roll over $100,000 to your IRA with the thought that you're going to maximize the QCD and do the $100,000, the first thing they're going to do is send you your RMD. So you might be less $30,000 out of that RMD or that rollover. If your RMD, for example, is $30,000. So it's going to be reduced by whatever that RMD is. And you have to take that as a distribution. You have to pay tax on it. Then, of course, you can roll over the remaining amount and do a QCD. Now, if you know that the first part that comes out is a RMD and you're going to have to receive it and pay tax, well, then you can adjust it and roll over more to fully optimize that $100,000. And the $100,000 is up to, right? So it can be anywhere from, I'm sure there's a minimum, but it can be anywhere from $1 to $100,000 for a QCD. Of course, you can roll over any amount you want, but you got to be aware that if you're already in RMD country, then that RMD has to come out first. So be aware of that. And what's the simple answer for that? Well, consider rolling over your 401k before you turn 72, before you hit that required beginning date and you enter RMD country, because then you have greater control over those IRAs and those distributions and conversions and all those things. So there are reasons to keep money potentially in a 401k, but you know, you've got to compare and look at what's best for you. So the next question, dear Mr. Slott, before I was married, I opened several brokerage accounts and a Roth IRA in my name alone. After marriage, I named my wife the beneficiary of these accounts. I'm wondering if we would be better off if I made her a co-owner. What do you suggest? I hear this all the time. So he said he has several brokerage accounts, so that's taxable accounts, and a Roth IRA. So let me read you Andy's answer first, but we're going to talk a bit about this because people get confused by all these different rules, and it's not reflective on the the knowledge of the consumer. But look at this first question that I read for you and that you're reading. So you got 401k, QCD, RMD, IRA, then all, repeat it over and over again. So you folks are much more astute because you've been following this webinar for some time now, but these things are stinking confusing. And if you don't study this, and if you just aren't, completely immersed in it, it can get very, very confusing. People make the mistakes of confusing rules of 401k plans and retirement plans and IRAs all the time. But this is a really basic kind of structure, and this is confused all the time. So he's asking, he has brokerage accounts from Roth IRAs. Can he make his wife co-owner to make things easier? So Andy writes, Mitchell, regarding the non-IRA brokerage accounts, we suggest you speak to a financial advisor to discuss the pros and cons of making those joint accounts. So of course he can make those joint accounts if he wants to. There are some ownership pros and cons to it that should be reviewed. As for the Roth IRA, however, he says that they can only be held by one owner. It's an individual retirement account, cannot be a joint account. Yes, of course, you should have your beneficiary named in there. That beneficiary only receives that account when you die. You can't gift an IRA to somebody else. You can distribute it and gift the money, but the only way you can pass money to IRA money to somebody else is if you die. So the only way to do that is name a beneficiary, and for it to stay an IRA. And you wouldn't want to distribute a Roth IRA during your lifetime just to put somebody else on there, because you're destroying the tax benefits of it. You can name, for most people, you can name your wife as the beneficiary of the Roth IRA as you did, but the account itself cannot be held jointly. All right, I see a question, so let me pause here and see what this question is. Douglas, hey Doug. Douglas, are the RMDs for 401ks higher than IRAs for the same asset amount? No, they use the same lifetime table. So you can see that lifetime table on my website, attleborowealth.com, and go to the slot corner and scroll down, and you can view that lifetime table. I think that's the one table you cannot download, but I'm working to get that fixed. But it's the same factor, just different rules. So for instance, 401ks and retirement plans cannot be aggregated. So if you have $1 million in 5 different IRAs, you can take an RMD out of just one of the IRAs for all 5. I hope that makes sense. So if your RMD for all 5 of those IRAs are $30,000, you figured out the portion that has to come out, and you want to take it from just one of those IRAs and not distribute a little bit from each one, you can do that. You cannot do that with 401ks and retirement plans, and you can't include, if you have $2 million in total retirement funds, and you say, well, why don't I just take my total RMD for both out of my IRA? This is a common mistake. Then you've violated the RMD rules for the 401k. It's eventually going to catch up to you, and you're probably going to pay some kind of penalty. So good question. Doug's joined us just in the past few weeks. He asked great questions. I appreciate that. Okay, so this is the article by Sarah Brenner. You've all met Sarah. How your IRA can help if you are a first-time home buyer. So let's read through this. So this may not be helpful for you folks, although you can, I don't remember the exact rules, but you can become a new first-time home buyer again in your lifetime, even if you bought a home before. But you may have children or grandchildren who are in this position, and you may not be, this may be helpful when they're thinking about buying that home and kind of needing all the resources that they can get together. So the real estate market is red hot right now, she writes. This can be especially challenging for first-time home buyers. IRA savings are intended to be used for your retirement. However, if you're like many others, your IRA may be your biggest asset. You may need your IRA funds to make home ownership happen, and there's a special break in the tax code that can help you. There are exceptions to the 10% penalty if you withdraw funds from your IRA prior to 59.5. So the government is not completely cold-hearted, although typically hard-headed. They're not completely cold-hearted, and they allow you to take money out in certain circumstances without that penalty. Now, of course, you still have to pay tax, and of course, you're giving up potential growth in these tax-free or tax-deferred accounts. But if that is your situation, let's see how it applies. Usually, if you're under age 59.5 and you take a distribution from your IRA, you will be hit with not only taxes, but a 10% early distribution penalty. However, Sarah writes, I'm right here, there is an exception for those who are looking to take the leap and purchase their first home. The 10% penalty does not apply to your IRA distribution that you use to buy or build a principal residence if you're a first-time home buyer. You can also use those funds to pay for the settlement, closing costs, and financing fee. So how do you have to qualify? Who is considered a first-time home buyer? The answer may surprise you. It's what I was talking about. You qualify as a first-time home buyer if you haven't owned a house in the past 2 years. That's right. Even if you had previously owned a home but sold it 5 years ago and rented an apartment ever since, you would qualify. If you're married, your spouse also cannot have owned a home in the past 2 years. You may use your IRA funds to help a family member with a home purchase if they meet the definition of a first-time buyer. Now, this only applies to you if you're under 59.5, because we're talking about the 10% penalty. If you're 65 years old and you sell your house because you want to downsize, but you haven't figured out where you're going to live, and you want to use IRA assets to then fund the purchase of the house when you find it, it doesn't matter, right? You're over 59.5. You can use your IRA for anything you want. It's under 59.5 that we have to be careful. $10,000 lifetime limit. There is a $10,000 lifetime limit on penalty-free distributions that you can use for a first-time home purchase. If you and your spouse each have your own IRAs and qualify as first-time home buyers, each of you can take $10,000 for a total of $20,000 for the same home purchase. If you take more than $10,000 from your IRA, the amount above won't be exempt from the 10% penalty, the amount above the $10,000. Once you use up your lifetime limit, it's gone forever. So you don't get to do that over again. And you have to use the funds within 120 days, not to be confused with 60-day rollover. The IRS likes to make things confusing. You must use the distribution within 120 days from the day it is received to buy your first home. If things don't go as planned and the home purchase is delayed or canceled, you may roll the funds back into an IRA. You have 120 days from the date of the distribution to do this, rather than the 60-day period, which is normally the deadline for rolling over IRA distributions. If you know somebody who's attempting this and it falls apart, even if they're attempting this or using this, keep good records. Make sure you keep good records. Make sure you upload everything to your whatever cloud you're using, and keep that all, because if you get audited, you're going to want to show that timeline, that purpose, and offering documents and agreement of sale, things like that. How to claim the exception. Remember, your IRA distribution will still be taxable to you unless you have basis included in the distribution. The tax break only gets you out of the 10% early distribution penalty. As I said, your IRA custodian will likely report the distribution as an early distribution to both you and the IRS. You will want to claim the exception to the 10% early distribution penalty when you file your tax return for the year. As with all tax matters, you want to keep good financial records, as I said, in case the IRA decides to ask questions. So you might also have a bit of a fight with your custodian, because under 59.5, a lot of custodians say if it's an early distribution, we're withholding 10%, the 10% penalty and potentially some tax. So that might be a separate issue for you. Okay. There is, let me pause my screen or stop my share. Gerard, good morning, Gerard. Do asset values, let's bring this down so I'm looking more at the camera. Do asset values in BDA, Roth, and TOD accounts have to be sold at time of death of owner, or may holdings be maintained as is? So a BDA Roth is a beneficiary designated account, BDA. So that's a non-spouse. Well, I guess it could be a spouse as well, but it's an inherited IRA, whether it's Roth or traditional IRA. And TD accounts and TOD accounts are transfer and death accounts, so they are not IRA accounts. They just, a TOD, transfer and death, is kind of a beneficiary designation that just directs the payment of the accounts directly to the person named as transfer and death designee, without and it transfers directly like a beneficiary. It doesn't have to go through probate or anything like that. So the accounts had to be sold at the time of the death of owner, and may holdings be maintained? The holdings can be maintained. The only reason potentially that you'd have to sell some assets within the Roth is for a required minimum distribution, because you as an account holder, an IRA, Roth IRA account holder, you don't have required minimum distributions, but an heir with a beneficiary designated account will have distribution. So I see no other reason, unless I'm missing something, I see no other reason that anything would have to be sold in that time. One of the things you're going to want to do is get, for the TOD account especially, is make sure you have a date of death designation, or excuse me, a date of death valuation on those. And you want to get those done pretty quickly, even if you're not planning on selling those assets in the TOD account, because it's harder if you go back 5 years later and say, hey, I need to get that date of death valuation from the custodian. So I would suggest you do it as a matter of process when you transfer the accounts. Good question as always, Gerard. Let's get that up there. Find my notes. Okay, let's talk about investments in the markets. So it's positive today. It was positive, it was mostly positive yesterday. They're talking about the US markets, but here was where we are year to date. I don't think I'm sharing my screen anymore. Let me just double check. Nope. The S&P 500 is down 15.13%. That the the Dow Jones Industrial Average is down 10.81%. In the last week alone, the S&P 500 was down 2.36. Dow Jones Industrial Average is down 2.08. And all the stock indices other than Master Limited Partnership are down significantly. The NASDAQ is 24% year to date. So I worry, I've shared with you that I worry less about the stock markets and I worry more about the bond markets. The bond markets overall are down 10%, 13. I'm just looking at different high yield bonds, 10.16, preferreds, 13.61, investment grade corporates, 13.19. So the average holdings of bond investors are down somewhere between 8 and 12%. And that's shocking to most people who have heard this discussion about, well, you adjust the risk in your portfolio as you get older to have more bonds. 60-40 portfolio is really popular, to have more bonds so that you minimize the risk of your stock. And we're seeing them both fall. And we know this as financial professionals, and we've been suggesting this for years now, but your lay people who do the target date funds and things like that, and then automatically ratchets towards bonds, are getting hit very hard and very surprised. Now, bonds they've gone down a lot more than most of us. I'm sure there's somebody out there who predicted that it was going to be this bad, but I didn't think it was going to. I didn't think we were going to hit the 13s and 12s for your average 7 to 9 year bond holding. But that's where we are, folks. So clients of ours have seen a lot of cash being raised over the past month or so. And that's in anticipation of some changes, adjustments with the bond market, and just a little bit of safety too. But that's important to, you don't want to be reactive, right? You want to build your portfolios with that foundation we talk about, principal or asset allocation, principal protection, and account segmentation. But there are times when you need to make adjustments. And we're going to talk about liquidations and capital gains. I hope you don't hear the lawnmower outside. But so the markets continue to struggle. And as I said, I think it's going to be a tough year. I told you in the beginning of the year that I think we're going to be up slightly or down slightly for the year with a lot of volatility. We're deeper than I thought we would be at this point, but we could certainly recover on the stock side. I think the bonds are going to have a longer ride. I think we could see negative bond areas for the next 3 to 5 years, honestly. So there are things we're doing to combat that, but I will get into those on an individual discussion basis with clients, not something to cover here. So let's talk about the S&P. So MFS releases this by the numbers. This is no recommendation to use MFS investments. This is just information they send us that I find interesting and want to share with you. So they talk about contrarians. So the S&P 500 was up 0.2% on a total return basis for the 1 year ending 4/30/2022. So the end of April 2022 compared to the end of April 2021, the S&P 500 was up just 0.2%. Now you remember going back 6 months from ago, we were looking at year-over-year numbers that were just astronomical, 25%, 30%, depending on the different index. The last 7 times they write, taking place since 2010, that the index recorded a negative total return, resulting on a trailing 12-month period. That's 1 year to 1 year. The index bounced back. So the S&P 500 bounced back each time with a positive gain of at least 15% over the next 12 months. The 1 year average return of all 7 comebacks is 27.6%. So what they're saying here is, have a positive outlook, because when we start to hit negative territory, we often have some positive territory most of the time. So I like positive outlooks. Be prepared for the worst and hope for the best, right? Talking about the bond market, the taxable bond market, they write, has produced a positive total return gain in 42 of the last 46 years, 1976 to 2021. That's 91% of the time. But it's on track for its worst year in history, down 10.1%. This is as of 5/5, so as of a couple of weeks ago, May 5th, 2022. The Bloomberg U.S. Aggregate Bond Index which is probably the most popular index that is used for the most popular bond category for investors, in my opinion. Calculating using publicly traded investment grade government bonds and corporate year yields with at least 1 year until final maturity was used as a bond measurement. Okay, so they're just telling you what the Bloomberg US aggregate index is, and that was down to 10.1%. It's down a little bit more as of today. So, so what does that tell us, right? There was a positive total return gain 42 of the last 46 years, 91% of the time. Now, you might see that as optimistic. That puts a little bit of concern, or quite a bit of concern, in my gut, because we've had such a great run in the bond market over the last really 15 years that I believe there's going to be quite an adjustment in negative returns as interest rates go up. Because we can't, what was happening in the past, over the past 15 years, is that interest rates would start to go up. We'd see bonds fall, we'd see the market fall. And then if it was from the market conditions, there would be an adjustment. If it was from the Fed trying to raise rates, they would pull back for some reason. The last reason was COVID. So we can't do that anymore, right? Inflation's at 8.3%. Everybody kind of sighed a big sigh of relief that it didn't go up to 9.4 that some people were talking about, because that would have been disastrous. But 8.3 is still pretty disastrous if it continues. Remember, we changed our assumptions in our financial plan to adjust it up to just 3.5, and we're seeing some financial plans struggle and some fail. So we've got to make adjustments. That's just adjusting it up 1%. If we have to go another percent to an average of 4.5, we're going to have a lot of work to do and some difficult discussions with people. So if you're, this is important for those of us, and it's really probably all of you that are focusing on tax efficient planning, because what this reads, and this is really, really great data, that fewer future taxpayers. The U.S. had 7.27 million births in the back-to-back years, 2020 to 2021. The American pandemic years, that's the fewest number of American births in back-to-back years in 40 years. The U.S. had 7.24 million births in 1980 and 1981, 30 years ago. 30 years ago, from 1990 to 1991, that doesn't make sense. That's not 30 years. So 30 years ago, same period of time, 30 years ago, 1 year, the U.S. had, I read 1990 and 1991, and then 30 years, and I just can't believe it. The U.S. had 8.27 million births in back-to-back years. So 8.27 and 30 years ago compared to 7.27 this from 2020 to 2021. So the point in this is, not only do we have all these other pressures, but there to potentially increase taxes, if not double in the next 10 or 12 years, now we have fewer future taxpayers. So fewer people paying Social Security from the baby boomers collect Social Security, and then the Gen Xers right after you have to pay into that. That's fewer. That's part of the problem. Same issue with Medicare and Medicaid. And now we've got fewer people to fund the taxes. Now, these are folks who were born in 2021, so we won't see that problem for another 18, 19, 20 years. But it's coming, right? And that happens quickly. And certainly for most of you, when we're at that point, there's no going back to work. Let's talk about state taxes. So one of the most common discussions I have when I'm sitting across the table or across the camera with someone who lives in New Jersey is, when I talk to them about the retirement goals, they often talk about moving from New Jersey, because New Jersey has high state taxes, but not as high as California. California has the highest state marginal tax rate in the nation, with a 13.3% top rate, kicking in at $1.25 million of taxable income. I'll tell you, my son lives in California and he struggles with state tax. Now, he's not making $1 million a year, but even at his rate and some other pressures, he is looking at leaving California and going exactly to what the neighboring state they talked about is Nevada, with no federal income tax, I think they said no federal income tax, but I think what they meant to write was no state income tax, because Nevada doesn't get any special treatment for federal tax one of 7 U.S. states with no state income tax. So there are 7 U.S. states per this information with no income tax. Good information. I like those points. It just keeps you thinking. All right. Give me 1 second. All right. So now we're going to jump into our financial planning topic right on time. And I'm going to share my screen again. And you're going to see my whiteboard. So when you see my screen, my whiteboard, and it's going to say financial planning topic, capital gains and losses. So my son knows to index that. Just raise your hand for me. Okay. Great. Thank you, everyone. All right. So why is this important? Capital gains and losses. And what does capital gains and capital losses mean? Well, let's get to the basics a little bit. So as always, I'm going to put my tablet down on my desk so I can properly draw as best I can. And I'm going to be looking down when I do that. Hopefully you can still hear me okay. Okay, just setting up my pen. So first of all, we're talking about taxable accounts. So let's talk about our buckets here. What happened to everything? There it is. Sorry about that. How do your eyes feel? All right. Let's look at our buckets. So remember, Microsoft changed this. Microsoft changed this whiteboard, and I am not a fan. Hold on. My apologies. It's become very sensitive, and I don't like to change it. So if you're listening, Microsoft executives, let's do something about this. So here's our taxable buckets. Here's our tax deferred buckets. And here's our tax advantaged or tax free buckets. So I'm not talking about this. I'm not really, in some cases maybe, but let's just focus. We're talking about this taxable bucket over here. So when I talk about income and tax reporting coming out of this taxable bucket, I'm often talking about interest, dividends, short-term gains, and long-term gains. And many of you suffered long-term gains and short-term gains last year when mutual funds they do trades within the funds, and they realize gains and they report them at the end of the year, and there's nothing you can do about it. And some funds like Vanguard had a retirement date fund that many people had in a taxable account. They were meant to be in this account, but they reported significant capital gains. People had to pay tax. So one of the things that we look to do when the markets are down 15%, 25% is harvest losses. There are times when these investments can be will hold losses, but they still might make sense to hold later on. So first of all, we're looking at the taxable account. Don't think that if your IRA is down, 10%, that you can sell the positions in your IRA and then change them or rebuy them 31 days later. We're going to talk about that and take advantage of any loss harvesting. It doesn't work in tax deferred or tax efficient. That should be an E, or tax advantaged, or tax free. I made a see what happens with this. All right, so let's go over here and talk a bit about what capital gains are. So this is your 2022 tax planning chart and how they're taxed. You can grab this from my website, outofourwealth.com, go to the slot corner, scroll all the way down to the bottom, and you're going to see these charts. So I'm talking about this section right here. Let's circle here. So long-term capital gains rates. Now, short-term capital gains are taxed here. So short-term capital gains act just like ordinary income. So what are short-term capital gains? Short-term capital gains are investments held less than 1 year. So therefore, what's a long-term capital gain? A long-term capital gain typically is an investment held longer than 1 year. So if it's held less than 1 year and you sell a position and you realize a $20,000 gain, it's going to be just like you earned that $20,000. It's going to fall into this marginal bracket, and then it's going to land somewhere, and you're going to get taxed on the marginal rate of that. That's short-term capital gains. Now, long-term capital gains, you have to come over here. So let's go over there. If your modified adjusted gross income falls below, and you're married filing jointly, falls below $0 to $83,350, then you don't pay any tax on your capital gains. If you're single, these are the rates here. Of course, it's just basically in half. And then for most people, they live right here. And there's an asterisk to this. So if you fall between $83,351 to $517,200, you're in the 15% capital gains rate. For many people, that's preferential to this area here, 22 to 24% marginal tax rate. So many people like to take capital gains tax over earned income tax. Earned income tax, ordinary income tax. Earned income tax is something with a local tax. So now let's pay attention to this, because this is important. 15% can easily become 18.8% though, because with the Affordable Care Act, there is a 3.8% Medicare surcharge tax for modified adjusted gross income over thresholds of $250,000 for joint filers and $200,000 for single filers. So be aware of that. And as always, when you're making these changes for tax reasons and not just investment reasons, consult your tax professional, right? Your tax preparer, your CPA. So the top rate, if you come up into this 20% bracket, capital gains tax bracket, then you could certainly be at 23.8 because you're going to be over $250,000 if joint, or $200,000 of modified adjusted gross income when you hit that, because it's over 500. Excuse me, it's over $517,200 for married. Let me get these out of the way for you so you can see that section. So this one's over $517,200 for a married couple and over $459,000 this year for a single filer. So 15 can become 18.8 and 20 can become 23.8. So you have to compare that. Capital gains is always cheaper, but they're gains. Now, what about losses? Now, what about if we go to these buckets, we come back here, and suddenly you have, let's just say you have $1 million. I need one more zero. $1 million in this bucket. And last year it was worth, let's call it $1.1 million. That should be a 1. Last year is worth $1.1 million. Now let's say you bought this these securities at $1.1 million. You invested $1.1 million a year and a month ago, just to make things a little easier. Now you would have a loss, let's do that in red, of $100,000. So could you sell those positions right now and book that $100,000 of loss? Sure. So there's a couple different reasons you might want to do that. What if you say, you know what, I don't like these investments anymore. They were fine a year and a half ago or a year and a month ago. And there's a reason I'm saying that. Now I want to make some changes, maybe reduce my bond allocation or something like that. So you could sell them, realize this loss, you book it, if you carry it on your tax returns as carryover losses, if you can't use them in the same year. So you book that $100,000 and you make the changes you want to make. What if you say, I really love this investment though. I really love what it's invested in. I love the funds. I love the stock. I love whatever it is. Well, you can still do it. There is a thing called a tax loss harvesting. So I hope you guys don't hear that. I must have somebody out there cleaning up my lawn that I didn't know about. Tax loss harvesting, you have to hold the position, or excuse me, you have to liquidate the position, and then you cannot rebuy let me just read the definition here to you. In order to make use of the tax loss harvesting, the investor cannot violate the IRS's wash sale rule. That is, the investor cannot sell an asset at a loss and buy a substantially identical asset within the 30-day period before or after the sale. Doing so will invalidate the tax loss rule. So I couldn't sell ABC stock and then buy a derivative of that ABC stock within that 30 days and try to cheat the deal, for example. But if you can do that, if you can wait those 30 days and buy them back, if that's what you want to do, then you get to still own these positions, and you book those losses, and you can use them against future gains or carry them over at $3,000 a year to write off against your income. So, and I'm not going to get too deep into the long-term capital gains and short-term capital gains, but if you have long-term gains and long-term losses and short-term gains and short-term losses, they first cancel each other out, and then they can cross. So if you end up with some positions that are, and you're selling at a loss and you've had them for less than a year, they can, if you don't have short-term losses or short-term gains, offset long-term gains also. So that's a little more complicated than a webinar discussion, but it doesn't have to line up exactly. So what are the advantages of doing that? Of course, well, it's like making lemonade out of lemons. You get to take that loss now, and again, you can, if you love it, you can rebuy those positions in 31 days. And if not, it gives you an opportunity to rebalance into something that might be more appropriate for now. What are the cons? Well, you can have a significant turnaround in those 30 some days, right? And that fund or those positions or that stock that you sold could have a run up, and then you miss that, and that happens sometimes. So you have to balance that. The other thing is, it doesn't have to be a loss. Sometimes we have, I've got some calls scheduled this week where people have had significant gains in investments, and they don't necessarily love the investments anymore, but they say, boy, I don't want to pay that capital gains. Well, that capital, it might still be a capital gain, but it might be significantly less than it was a year ago, or it may be a year from now. So this may be an opportunity to pay less in capital gains. So the first opportunity is, first we have to pay attention to taxable accounts. The first opportunity is to rebalance or adjust investments for loss or a lesser gain. You don't have to wait necessarily for it to be a loss. And then we talked about tax loss harvesting. We got to wait those 31 days. And again, it's just a way to make a positive out of something that is difficult right now. I don't want to necessarily say negative, because this is just how we, things we have to go through. So I'm just checking my notes to see if I've missed anything else. So we talked about, we do have to sell these positions. They do have to become realized losses, not unrealized losses. So we have to sell them. And then you can buy them back. You can, if you want to exchange them into something completely different, you don't have to wait the 30 days, right? But if you want to buy back substantially equal or similar positions, then you have to wait those 31 days. You can offset them against future gains. So if you know that you're going to be selling positions later on in the year, and there's a potential gain in those positions, you can take a loss and then sell those positions to so you don't pay any tax. If you have $100,000 gain, going back to this example here, if you have $100,000, loss in this position, right? You have $100,000 loss in this position, but let's say you have another $1 million here. I keep missing that zero. Another $1 million here that you bought for $900,000, and you could sell that at the same time, and that here you got $100,000 gain, and over here, and it can be in the same account, or it can be in a different account. You have that loss. Well, that $100,000 gain can be realized, and then you can offset it with this loss immediately and not pay any tax, right? Or you can just bank it for further use. If you don't use it this year, you can deduct potentially $3,000 off of your income. Check with your CPA, or you can carry it over to next year. And if next year you sell this $100,000 position for a gain, well, then you have, easy math, right? $97,000 carryover of this $100,000 that you can use to offset that gain. So I hope that all makes sense. I know it's a little confusing, but I think it's something that's important to talk about. And be mindful, again, look at these tax charts. Some people can get away with 0. Most of us are going to pay 15%. Some will pay 20, but pay attention to this 3.8% Medicare surcharge tax that sneaks up on people, and I don't want it to sneak up on you. Be aware of what that tax cost is going to be if you're paying gains. Okay. I hope that was helpful. Let's see if we have a question. If I have a loss, it's better to sell at short-term loss than a long-term loss. Well, it all depends. So a short-term loss is going to first offset a short-term gain, as I said, but not necessarily. So I guess from a tax perspective, it's bad. You get more bang for your buck on a short-term loss, right? But you will potentially offset that with a long-term gain. So your offset is still the the 0, 15 or 20%. I hope that makes sense, Doug. So good question though. Okay, folks, that's it for today. I've lost my cursor. I got this quiet mouse now, but I'm still trying to get rid of it or get used to it. I hope you don't hear me scrolling anymore. And that was also good advice. Let me stop my share. Looking forward to seeing you all soon. We have a lot coming up. Stay tuned. I hope you're enjoying the webinar. Somebody told me that they've gone through about 80% of my videos that are on the website. I love hearing that. I'm so glad it's helpful to you. Thanks for not beating me up too bad. I know the presentation isn't always perfect, but we all have fun and I appreciate that. But have a great week, everybody, and we'll see you next week. Take care.